All right. So far so good. Are you understanding the other block I'm explaining?
Yes, I'm trying.
The stuff is usually it's gonna be like uh it's going to be like difficult in the first instance, but the more you watch videos on it, the more you this is just me trying to expose you to this stuff you get, because definitely you're not going to get all of these concepts instantly, but the more you watch videos on it, the more you watch uh other people explaining it, or the more you watch my analysis, you're going to understand this, and it's going to be very, very easy. So let's continue other block. So I told you that this was the OB, right? In this case, this was the OB. So you can have different OBs on different time frames. This is on, we were on the 4 hour. Now I'm switching to the 2 hours. Now, you know why the concept of OB is very, very important. It's because it's actually a trading concept that usually works a lot of the times, especially if you're able to spot the right order block to trade from it. Kagane. And if you're also able to understand the order flow of the market, where the market is heading to, you don't just trade order blocks blindly. You have to trade order block in confluence with the direction of the market. That's if the market is going down, you're not going to be concerning yourselves with a bullish order block that is supposed to cause the market to go up. You know, definitely that order block will most likely get violated, right? Because the market is trending downwards. So let's look at this order block I had marked out here. Now, what did I say is another block? The last bullish candle before the bearish move to the downside. And I said a bearish order block is the last bullish candle, which is this one, before the bearish move to the downside. So this is our order block. Let's mark it out correctly. This is our order block. Cool. So what did I say is the criteria to make an order block a valid order block? I mentioned two criteria. I say one, we must see a very strong bearish push to the downside like this. That means you need to see a very strong move to the downside. You don't want to see a choppy movement after the last bullish candle. You need to see a very strong movement. Now, let me give you an example of what I see I don't want to see. I don't want to see this kind of movement on my other block. You get Kagan, you see how here is choppy, 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 choppy. No, we want to see a very strong push out of that other block, like what we have here. You get? Then the next thing is we want to see the other block to cause a change of character or a break in market structure. Have you heard of the term break in market structure before? Huh? Have you heard of break of market structure?
No, no, I haven't.
Okay, so we have a break of structure here. You can say a break of market structure, break of structure, BOS, or break of market structure, BMS. Some people label it BMS. You get? So break of structure is when price break structure and move in and continuous moving in its direction. You get? This is what the break. Let's just use BM break of structure so that we don't make it look somehow. So this is a break of structure. Why is it a break of structure? Because it broke structure and formed a new low. This was the low. This was high, lower high, high, low, lower high. We got a lower low here. Do you understand? So this is why this is called a break of structure, because price has broken structure to the downside. It could be a break of structure to the upside or a down to the downside. Pagani. So this is why this right here is a break of structure, because price broke this low and formed a new low here. Do you understand? Hello?
Yes, I understand.
Yeah, good. So this is why this other block is going to be a valid order block. So if you were a trader and you were monitoring this market, observing this market, the moment you saw market form, the price form this order block here, the next thing you're going to do is to anticipate price to come back into the order block, then you sell from there. So that is how you trade an order block. So you will have sold from here, put your stop loss directly on top of the order block, or you could put it on the wick of this candle or on the order block like this. Then you're going to take profit at the other end of the market. So this is just it. So this is it, bro. So if you were trading an order block based strategy, this will have given you like 1 to 5 weeks to reward. This will have given you a 1 to 5 weeks to reward trade. As simple as this is. As simple as this is. It will have given you a 1 to 5 weeks to reward trade. Sorry. So, bro, is this beginning to make sense right now?
Yes.
Now, let me give you another very sweet example of order block. This is another block here. And why is it another block? Because this was the last bullish candle before we got a very, very strong bearish move to the downside. Do you understand? And then the bearish move broke structure here. This was a low. This wick here was a low. It broke it and formed a lower low. You understand? So this is a valid order block. This is the last bullish candle. Then we had a strong move to the downside, which broke structure. So if you are somebody that understands order block, you understand market flow, market structure, and you're using an order block strategy, then this will have been a very, very fantastic trading opportunity. You will have placed your trade directly on the order block, put your stop loss right on top, yeah, and your take profit down. This would have been 1 to 3 weeks reward trade. You understand? So this is just the idea of an order block. This is just what an order block is and how you can trade another block. So you can find order block on different time frames. You can find it on 1 hour, 30 minutes, 5 minutes. You can find other blocks on very different time frames. It's not just on the higher time frames. But as I said, the other blocks on the higher time frames are usually the stronger order blocks that will most likely hold. The other blocks on the higher time frames are usually the stronger order blocks that will most likely hold, unlike other blocks on 5 minutes, 1 minute. And when you're trading other blocks, you need to trade the other block in the direction of the market flow. So if the market is trending upwards like this, in this particular case here, where the market has been going upwards like this, that means you're going to be looking for only bullish order blocks that are going to continue the trend to the upside. You get? Not to be looking for bearish order blocks. I don't know if that is clear. So I guess we have said a lot about order blocks. Let me look for a bearish, all of these examples I gave here were like bearish order blocks, right? So let me look for a bullish order block so we could see how it worked. So the thing is, not all of the time that these things work exactly as I have explained. That's why you have to always, always manage your risks and trade very carefully, because I'm about to show you an example of an order block that did not hold, that did not play out, and which is this particular order block here. Now, if you look, you see that this is a bullish order block, the last bearish candle before the bullish move. So let me draw it out so that you see, right? And this order block is even very valid. Why? Because it broke structure to the upside. This was the high. before the other block, but the other block had a very strong volume. See the strong momentum it used to pushed and even broke structure here. Look the new structure it created, right? Created a new structure here. So now, usually you will expect that when price comes back to the other block, it will respect it and continue going to the upside. So you will have placed your trade here, placed your stop loss directly on the other block, and target probably somewhere up here, right? But if you see it, you will now see that it didn't hold. It didn't hold. The other block failed. So it's not all of the time that the other block will just work. You cannot just be trading another block just for another block's sake. You have to combine it with a lot of other confluences. You have to look at a lot of other things. Is this other block at a supply or at a demand zone? When am I trying to trade this other block? Is it at the proper session? Is it at the London Open or New York Open? Is it when there's a lot of volume in the market? Is this other block formed at a liquidity area that price will likely clear and grab more orders to move to the upside? So there are a lot of things that will influence what or which other block you will consider a valid order block to trade from, or another block that you will ignore. Because when you look at the chart, you will find a lot of other blocks everywhere on different time frames. If you go to the 1 hour, you see a lot of other blocks on the 1 hour. You see a lot of other blocks, even on 30 minutes, 5 minutes. In fact, you're going to be seeing a lot of other blocks. But you need to like have more than just other block as the reason for going into a trade. You need to have more than just other block as the reason for going into a trade. So you're going to be considering this other block. Where is it forming? Is it forming at a demand or a supply zone? Is it forming at a liquidity area where price will likely go and take out? You get? So there are a lot of other things that you have to consider. But don't worry, as you continue to learn gradually, it will become very clear for you, and you will figure out how best to trade them. Now, let me give you another example of a bullish order block that played out very well here. So we have a bullish order block right here. Right here. So why is it a bullish order block? Because this is the last bearish candle before the bullish move that broke structure multiple times to the upside. So it broke structure here. It broke another structure here. So this is a valid bullish order block. Then see what price is. After price had gone, it came back, tapped this order block, and continued very nicely to the upside. So you will have placed your trade like this, and then you will have placed your target far above. So you see how this actually played out. In fact, played out very nicely. So this is an example of bullish order block that played out in this scenario. So I guess I've talked extensively on other blocks. So let's try and go into the next item, which is an imbalance or a fair value gap. So what is an imbalance or a fair value gap? They actually mean the same thing. Either you call it an imbalance or you call it FVG, which is fair value gap. So Lawrence, I see you. Welcome, bro.
Thanks, man. Thanks, man.
You're welcome, bro. Saeed, are you still with us?
Yes, I am.
So how far the explanation of the other block? I know it's a bit confusing, but so far, have you gotten something from that explanation?
Yes, sir.
It's all right. Don't worry. The more you go over this, the more you learn and go over these concepts, the clearer they become. So the next thing we're going to talk right now is imbalance. And what is an imbalance or a fair value gap? So as I told you, the market is about buying and selling. Before the market can actually move, we need to have equal or presence of both sellers and buyers at the same time. Because when you're buying, what you're actually doing is you are collecting from somebody that is selling. So someone is selling at the other end and you're buying from them. So that means there need to be the presence of both buyers and sellers at the market at all times for we to have like price move. So now an imbalance is where you have an area in the market where there's unequal amount of buyers and sellers in the market. So now look at this, please. You see this long candle, right? You will call this candle an imbalance candle. Why? Because price did not have enough room to correct itself. You see in this, let me delete this first. Let me delete this. So you see this long candle right here, right? Let me also delete this. Delete this. You see this long candle right here. This candle is an imbalance candle. Why? Because price did not form efficiently at this place. You can also call an imbalance inefficiency. So usually, this is how a normal price movement is. You see this movement about here. This is usually how price moves normally. Very, very efficient. We have a good number of buyers and sellers exchanging themselves, exchanging to themselves, and then price is going to the direction of where we have more of either the buyers or sellers. So in this case now, we have more buyers in the market, but at least there are sufficient amount of sellers who are able to take up these orders, and price is moving gingerly. Price is moving the way it's supposed to move gingerly. But when it now came here, we saw this very strong push straight downside. Boom! Like from nowhere, we just saw a massive amount of sellers in the market that didn't even give buyers a chance to buy this market. So we just saw a lot of sellers that pushed the market to the downside. Boom! So whenever you see this kind of crazy move, that move leaves behind an imbalance or inefficiencies. That means it leaves behind like unequal or unfulfilled buyers or sellers in that market. So whenever you see this very strong move, one candle giving a very strong push like this, there's an inefficiency in that market. And usually market will come back to correct that inefficiency. That is the idea behind imbalance or inefficiency or fair value gap. Fair value gap. They are all the same thing, just different currency, just different English, just different grammar. So whenever there's this inefficiency, price will always do what? Price will always want to go and correct that inefficiency. So this is the ideology behind the concept inefficiency. So people know this and they use it as their confluence to trade. They use it to trade. So the idea is that price will always want to come and fill in this inefficiency before it continues moving in the direction it wants to move. Now, you see, let's use this very short uptrend that occurred here, for example. Let's use this uptrend, for example, right? So the direction of the market is what? Is bullish. The market is trending upwards, is in an uptrend. Then we have this very forget about this inefficiency right here. Even though you will even see that this inefficiency was corrected, you see that price came back and corrected it a bit before it came back down. Then it now started the uptrend. So most of the times, it doesn't happen 100% of the time, but it's good that you have this knowledge. Most of the times in the market, price will want to come back to correct the inefficiency, to correct the imbalance. So you see here, price corrected it a bit. And the rule is that price will correct it at least to 50%. It's not all of the time that it corrects it 100%, like cover it up 100%. No, but at least 50% of the imbalance will be corrected. So now let's use this particular candle as the case study of this imbalance. So you see the direction is up, right? So price was moving. We had price break this high, which is a good sign for us to say, whoa, price has broken this high, this structure to the upside. So we're likely going to see a continuation of this uptrend, right? So price broke this structure, but it broke it with a crazy candle that left an imbalance on the chart, and this is the 1 hour time frame. So the idea is that price will likely come and fill in this imbalance before it to continue moving to the upside. So if you're a trader that understands the concept of imbalance, you're going to be looking to take an entry around this place. This whole imbalance is where you're going to be looking to take a trade because you believe price will correct this imbalance before it will continue moving to the upside. So if you believe that price is going to correct at least 50% of this imbalance, what you're going to do is to look forward to taking your trade around 50%, around the mid-level of this imbalance. Let's assume that this is the middle. So what you're going to do is you're going to be looking to take your trade around this level. So you can place your trade here, put your stop loss at least at the next candle and target above, just in this case. So this is just what imbalance is and how you can treat the concept of imbalance, as simple as this is. Lawrence, I'm sure this is very, very clear.
Yeah, it's very clear.
Yeah. Said, how about you? Do you understand this concept
Yes,
of imbalance?
yes, sir.
So good.
Yes, sir.
That is just what imbalance is. You knowing that, okay, whenever there's an inefficiency in the market, the market will likely come back and correct that inefficiency before it will go in its direction, before it will continue moving in its direction. And I personally, what I do right now is I usually combine, I have come to realize that in when considering an order block, an imbalance, and liquidity, I've come to realize that what is most important is liquidity and imbalance. Order block, most of the time, in fact, as it is now, order block now rubbish. I won't say it's rubbish totally, but then I don't usually consider order block like that, like before again, because I've noticed that what drives price is liquidity. Liquidity is what moves price. Lawrence, this is especially for you. Now, let me show you something, Lawrence. You know, this is on the 1 hour time frame, but this thing like improved my entry like by so much when I understood this thing. Now, you see, this is on the 1 hour. So you know that this is another block on the 1 hour. This particular other block.
Yeah.
This is another block on the 1 hour. So assuming you now, you're waiting for the other block, you know you wouldn't have gotten this straight because price never came back to the other block. You get? Price
Yeah.
never came back to the other block. So what I usually do is when I see an imbalance and I understand that price has started moving in its direction, once I understand that, okay, this is London open, probably price is now going in the direction of the day. Because if you see this move right here, you will know that this move took out liquidity here, even tapped this other block. So
Yeah.
the order flow is in place, like market is flowing properly. Then after it tapped this other block and then it started going up, it pushed up so much like this. The next thing I'm going to do is to come down to the lower time frame. Let's go to the 15-minute and see what's going on there. My network is kind of slow today. You guys should bear with me. My network is really slow, man. I don't know why. What I want to do is to show you how immediately price takes out the liquidity and at least touches the imbalance, no matter how little, you're going to see price move. It will not even come near that other block. Like nothing will concern her with the other block again. What price will do will just take the liquidity, some of the times fill the imbalance before it move. And this isn't like something I will say it happens 100% all the time. But at least having this knowledge will also help you to avoid those times when you just be sitting on your hands waiting for the other block to get filled. What's going on? Why is this chart not loading? Ah, oh man, this network is really terrible, man. Oh my God, I can't even see my this thing again. No, can you imagine? Okay, I think it's loading now. But this is terrible, man. Why is this
The
thing
network
loading
is
so
really
slow?
bad.
Ah, man. Okay. So this is the example right here. And I don't even want it to go on. I need it to be on the 5 minute or 3 minute or 1 minute. So this is the other block right here. This is the other block right here. But you see, price never even came down to the other block. It reversed right about here. Now, what has most likely happened is that there is another block. There's probably another other block here. Because if I go to the 3 minutes, the problem is that this thing will load forever. If I go to the 3 minutes, you're gonna see that there's another other block there, or something like an other block there that price reacted from. And why price reacted mainly on that other block is because there was liquidity. It's because there was liquidity that price took out before it reacted on that other block. So what me I've realized right now is that most of the time when there's a liquidity and another block, what you should target is that other block that is directly under the liquidity or directly above the liquidity. It's very unfortunate that this network is very slow.
Sorry, please. I came quite late. I don't know if you can talk about liquidity again. I really want to know the
Oh,
meaning of
we've not actually
liquidity.
talked about liquidity. I was just saying this because of you. The next item is actually liquidity.
Oh,
So we are on imbalance now, and I think we're even done on imbalance. So the next thing to talk about right now is liquidity. So once this
ah,
once this stuff loads, we're going to talk about liquidity. It's quite unfortunate, man. Let's look for it. I guess we'll even do liquidity on this time frame so that we don't get to like suffer from all of this loading. Just bear with me, guys, please. This usually doesn't happen to me. I wonder why it's today that this is happening. So, but before this loads up, liquidity is simply like petrol or fuel for price. Liquidity is like the petrol, is what propels price. Liquidity is what makes price to move. Because you know what liquidity is? Liquidity is orders that are resting in the market. Liquidity is like the buy orders, sell orders, sell limit, buy limits, buy stop, stop loss, take profit. That is what liquidity is. And that is what is needed for that is what is needed for price to move the way it is moving. That is what is needed for price to move the way it is moving. Oh, I have just less than 10 minutes to round up this class. If not, this class is gonna close. So let's just be fast about it. Oh, this is terrible, man. I don't even know what these guys are now showing me again. Oh my God.
Can't load unless you upgrade.
No, I don't think it's unless I upgrade. It's just misbehaving right now.
Oh,
Yeah, let's just continue, guys. Let's just continue. We look for another example. So let's do our stuff on these 3 minutes. Now, what is liquidity? Liquidity is an area on your chart where you're going to be having orders resting there. Liquidity is an area on your chart where you're likely going to be having orders resting there. So you're likely going to be having some sellers selling there or buyers buying there. Then you're likely going to have your stop loss there. You're likely going to be having your take profit there. So all of these orders that are resting on the chart, they are actually what price feeds on to continue moving in the way it wants to move. Now, let me give you this example. Now, price is going up, right? Like right here, price is going up, right? Look at this very short example. So if price is going up here and we have somebody that bought around here, right? Let's say the guy placed his buy right here, right? Then price bought. Then when price broke structure here to the upside, we still have more people that are like, this market is buying, or this market is buy. Let's place more buys. Then somebody placed his buy here, placed his buy here. The moment the person placed his buy here, market now continue moving to the upside. The moment market moves to the upside, he says, fine, I'm in profit. I'm going to place my stop loss on this week. He now places his stop loss on this week. I don't know if you guys can see this illustration I'm giving. Lawrence, can you see this thing I'm showing you clearly?
yeah, I can see it's very clear.
Good. So now, this stuff you see here is what liquidity is. And price will likely come to take out this liquidity to have more fire to continue going to the upside. Why? Because I told you, if price wants to buy, it needs sellers before it can buy. You understand? So when price wants to buy, it's going to come back down to grab sell orders, to grab stop losses, all of those things that will make it propel to the upside to buy. That's what price will come out and come back and take. So we have that is just simply what liquidity is. Liquidity is the fuel that propels price. So liquidity is all these orders, sell orders, buy orders, stop losses, take profits that are placed everywhere on the chart. You have to just have an eye that sees and understands what liquidity is for you to be able to trade liquidity. You need to understand that resting on this chart are different areas where you will find different things, different stuffs. Now, let me show you. You see, there's liquidity resting everywhere on the chart. I have 5 more minutes, guys. So there's liquidity here, liquidity everywhere, bro. Liquidity is everywhere. You just need to understand where this liquidity is for you to be able to trade it. Liquidity is everywhere. Liquidity is everywhere. Everywhere liquidity. You just need to understand where and which will the market come and take out. So all of these places, we have buy orders, we have sell orders, we have stop losses, we have all of these things in every place littered around the chart. You need to understand where exactly these things are and which one will price likely come and take out for you to be able to make like meaningful trades. So now let me draw a very quick diagram. Whenever price is moving in a range, there's what we call an internal and an external liquidity. So price will always take out liquidity before it moves. So let's assume that we have a range like this, right? Then we have this isn't the best. Let me draw another one. So we have something like this. Price is moving like this, right? So this is price movement. All of these things that you see here are what is called, because this is the range from the top here to down here. This is the range. So if this is the range, what will likely happen is that price will want to come and take out all of this internal liquidity before it continues moving to the downside. So these things you see here are liquidity that price will likely come and take out. So if price is moving like this, what you're likely going to see price do is to come back up, take out this liquidity, and then continue moving to the downside. Lawrence, did this make sense?
Yeah, it does. It does. I can now
Said,
clearly get it.
Said, does this make sense? I know you may not really get
Yeah,
a
I've
full
seen a
grasp
lot
of this.
of charts like this one.
Good. So what price is doing is looking for more fuel, looking for more petrol to move. So it 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 has to, like, it has to get fuel and move. So this is the liquidity that is resting. So it's likely going to come and clear the internal liquidity, then get more ginger to move. Trust me, price will never just move away just straight up like that, except if we have like an event or something. If not, on a normal, what price will do is the moment it takes out a liquidity, if you're able to spot that liquidity, bro, you don't make up, that price will move. You know what? When this class ends, I'm going to start another one so that I show you guys live example of how this thing plays out, of what this thing does. So the moment price takes out the liquidity, if you're able to spot the liquidity, just know that you're gonna bank that trade. Just know you're going to bank that trade. So first of all you need to do is to know the direction of the market. If you know that the market is going down, nothing the shell, this market is going down. The next thing you need to be able to ascertain is where the liquidity is lying, is where the liquidity is resting. If you're able to know where the liquidity is in the market, then you're sure to get a trade. So all you're gonna now be doing is to wait, is to watch price and see when price comes back, takes this liquidity. Sometimes it can do something like this. It will come like this. This is what we call an inducement, to do something like this. Then finally come and clear it. When it clears it, then it will now come back down. Lawrence, you may have seen something like this happen in the market. So usually what you get to see after the liquidity is an imbalance or another block. So what I have come to realize is that in priority, in order of which holds the most, first of all is liquidity, followed by imbalance, then other blocks. So when price takes out the liquidity, it either fills in an imbalance more or it taps another block and continues. But if price doesn't take out a liquidity and you see other block, now SL be that too. It will hit your SL because price must take out liquidity before it moves. If it doesn't take out liquidity, it's not going anywhere. So when this class ends, I'm going to show you guys a live example of liquidity and like how you can actually use it to trade. So just messing.